So I just wanted to share a comment that was made, and whether this person said it in the slide or not, I have no idea, and he may not have intended it, but there was this underlying tone that came out that I thought was really interesting, and whether he meant it or not, I think this is a concept that sometimes is done a lot, where in boot camp, what Stephanie really teaches is the discipline of really having good mapped out trades. She'll go through, and most of you who have been in here and everybody who's in boot camp knows this, but for the most part, everyone who's been in this room for very long have seen how she selects her whispers. And she's looking at pre-market volume. She's looking at entry levels. She's looking at what we call the roadblocks or the potholes in the road, because we're mapping out potential trades. And she'll map out, 60, 70 trades sometimes, because they're all setting up and knowing that perhaps only 5 or 10 of them will actually come to fruition. I mean, some days all of them work, but you never know. And so you're always wanting to map out more trades than others. But the point being that she has precise entries and precise stop losses and precise exits targets. And you can have multiple targets so that you don't have to deal with exititis, that inflammation that goes with exiting out of a position too soon. But you have some targets where you're at least going to take some profits off the table. And some of the questions that came around was, well, when would you move your stop loss and at, when would you adjust your target? Would you do this and that? And the comment that came across was, well, I'm in the options. So, and like I said, this person may not have meant it that way, but in other circumstances and in some of the coaching sessions that I've had so many times when someone will say, well, I'm in the options, so I can give it more room. And, my question is always, well, if you have mapped out a trade, and it's one thing if, in a day trade, perhaps you're going for a 4-cent stop loss, and in the options, that's going to translate only to 2 cents. But the thing is, typically what a stop loss, if it's well placed, if your entry is precise and if your stop loss is well placed, your stop loss it is partially to save you money so that you're not taking on longer or larger losses. But what that stop loss is really saying is, hey, this either bullish or bearish view that I have on the stock is no longer valid. This technical pattern that I was following is no longer valid, and therefore I'm going to get out. So if that's the case, it shouldn't matter if you're in an options trade or if you're in a stock trade. And a lot of times as new options traders, you get lulled into, well, I can ride this out a little bit more because, darn it, every time I set a stop loss and I get stopped out, the stock just then takes off. and I don't want to be there, so this time I'm going to let it go. And invariably, you end up losing more money because the technical pattern has changed. And so if you're ever in doubt, and this is where you really need to get disciplined about journaling your trades. If you're ever in doubt, it's so much easier when you're trading to say, darn it, this happens to me all the time. Every time I get out, it moves. But if you were to actually write down every single time that when you got stopped out, that it ended up saving you more money than not, versus you missed out on a greater move. I am, we don't want to bet in here, but I would be willing to bet that you actually save more money by honoring all your stops. I'm going to go get a drink of water and I'll be right back. Okay, I'm back. Besides, I wanted that to kind of sit in and soak in. So, what are we looking at today? Any stocks you guys want to look at in particular? And Stephanie, if you're here, I didn't get around to putting up the news. If you could just post anything transfer anything that's worthy that comes through, that would be appreciated. Somebody just said Disney. Depending on where Disney closes, this might be a short. So I like that. You analyze the trade and get in. If it goes against your direction, don't trust that it has to go my way. You should just tell yourself something is wrong. Get out and then figure it out. Yep. Typically, unless you're one of these people that absolutely love just really fast momentum trades, most stocks will give you an opportunity to get back in if it's the right way. I'll repeat what Stephanie says all the time. Don't get married to your trade. When you are so sure that a stock is going to go up or a stock is going to go down, and it does it the other way, it goes the other way, and you're holding on saying, oh, at the next resistance it's going to turn, or at the next support, surely this time it's going to hold, and then it's going to bounce up, and it's going to come way, way back up. I'm going to take this huge loss into a winner. That's when you are putting your ego into the trade. You have married that trade instead of watching what it is. You just need to trade what you see. And especially with FOMC coming up, so the Fed meets 8 times a year, and then if they can always call in emergency sessions or additional sessions, but on a regular basis, 8 times a year, they meet, and then 3 weeks after their meetings, they release the minutes. And the minutes, you'd think that, the minutes have already been, everybody already knows what happened in the meetings because they usually have press conferences afterwards and they talk about it. And for 3 weeks, the talking heads are talking about what was discussed in the Fed meetings. And yet, the moment the minutes are published at 2 o'clock, sometimes the market can really move. Now, will it always move? Well, of course not. Nothing is 100% in the market, but a lot of times it will. And so if you're brand new to day trading around the FOMC minutes, consider it like we talk about with earnings trades. You know, we tell you you could have a nice run up into earnings and then get out, because then you could always get back in after the earnings are announced. So think about that and just watch it at 2 o'clock. And like I said, sometimes it won't move at all. But, oh, okay. Thanks, Ron, for the dollar, the Spain thing. And so think about think that something can happen, and don't try to predict, well, the Fed's, dovish or hawkish, and ergo, this should happen with the market. The dollar should do this. Well, interest rates are going to do this, and therefore the bonds should do this, or the financial stocks should do this. Never get into that should. Just watch the price action, because you never know what's already been priced in, what hasn't. So typically on FOMC days, as in tomorrow, gold moves. So as an options trader, personally, my two favorite are to trade the GLD and the GDX. The SPY can move. And I realize we've talked about the SPY lately. Sometimes it only has she only has a 30-cent range sometimes. But as a day trade, you could get in a quick 50 cents a dollar, even in our low movement days recently. So that's one to look at. SPY does have really good liquid options. Another one, don't ask me why, but typically FCX is a good mover. Another one is the bonds. So TLT is one that I like to trade, has the best options. And the financials. And personally, I like to trade GS. However, having said that, let's look at some financial stocks right now. Because this is part of what I do in assessing. I'll share with you some of my thought processes. So I like GS just because she moves. But she's a little bit trickier in that in her options play, it's easier to trade stocks or options that just have a dollar strike price interval, and GS has 250. So among the dollar and the 50 cent, the three candidates I like the most are JPM, Citi, and Wells Fargo, WFC. So let's look at all of them. So here's Citi. And what I'm noting here is I'm just getting a first glance of, okay, well, Citi is in this nice uptrend, pulling back, really bullish. Yes, absolutely. And that's what I'm getting at, David, is this is what I'm going to show you is, yeah, I don't trade Morgan Stanley for some reason, but actually MS has really good options too, so we could put that in the fray. So Wells Fargo, you could see that it's in this really nice bullish trend, pretty well behaved, and who knows, could do this, or I don't know, could do this, or well, might do this. But anyway, right now, this is steady, good slope, not parabolic and not sideways too much. It's actually in a real nice slope going up. JPM. Well, JPM's a little bit different. JPM's had this nice move. This might be considered a diamond pattern here. If it's a diamond pattern, typically a diamond pattern it can be a reversal or continuation pattern, but the diamond pattern typically movement, that's the height of the diamond in either direction. And so we can expect possibly, this is what, a 98 to 95, $3 move. So we might get a move up from the apex here. So we might get a move from 97 to roughly 100 or back down to 94. So this isn't quite that regular up pattern that we saw in City. Let's look at Wells Fargo. That's my next one. Okay, Wells Fargo. Here's one that looks yet a little different. And this one is kind of... So if you were to assess between the three, I would rank them as that City here, then JPM and Wells Fargo. Let's look at MS since you mentioned MS. Morgan Stanley. Okay, Morgan Stanley looks a lot like Citi. Agree? So MS is roughly equivalent to Citi, and it's really bullish. And so what I might do on something to identify, if I see the financials, because what I'm looking at is that on the FOMC reaction, if we get no movement, this is typically the pattern. So they come out at Wednesday at 2. And then you still have Thursday trading and Friday. So typically what happens is we either get this violent immediate reaction at 2 to 3, 3:30. And if that does not happen, we typically will get a reaction the following day. That's just typical. But of course, we all know that as soon as I say, look for this typical pattern to occur, that it won't. But just to have an idea of what might happen, in either case, what happens a lot is that these stocks, the other one that I didn't put up was VIX products. So VXX is the one with the best options. So that's one worth looking at. So to summarize again, it's let's see, VXX, FCX, TLT, GLD, GDX, and financials. And in my case, it's Goldman Sachs. But so what I wanted to go through here, though, is that either way, the financials are one that has a potential to move. And so what I want to identify is, well, if it's a move to the upside, to me, Morgan Stanley and Citi have the strongest of the four patterns or the four stocks charts that we saw. And so if there's a move to the upside, what I might want to do is load up, ready to go, and have some call options prepared in advance so that I know as soon as a target is hit. And what I want to do intraday on FOMC is to go ahead and put a bracket, and this is going to be based on that particular stock. I want to also look at XLF and identify that, before 2 o'clock. Well, if it's, for instance, if we were at 12:45 tomorrow instead of today, I might say, okay, with Morgan Stanley, bullish above 49.50 and bearish below 49.25, for instance. Or I may say, well, I've got this spike, so I want to get above that resistance, and I want to get below that support. Whatever you decide, but you have a bracket trade so that it's bullish above and bearish below. And for a bullish trade, I want to take the strongest of my financial, and if a bearish signal is triggered, I want to take the weakest. And so I may decide, okay, well, if I see something strong, I want to go with buying calls. So my bracket trade is something like this, where the stock's doing this, and all of a sudden on FOMC it starts to break up or down. And so basically what I'm setting up is, if to the upside, I'm going to buy calls on either Citi or MS. If my downside trigger is hit, I may say, okay, I want to buy puts on JPM. Whatever you decide, or Wells Fargo. Or you may decide, something else. Look for something. So then, between Citi and MS, here's what I would, if you're a beginner options trader, and if you've never traded the strategy, first of all, please paper trade. Do not do this with real money, as well as do not do this with lots of real money. But the difference between MS at $50 and Citi at $75. Okay, so Citi is a $75 stock. MS is a $50 stock. Roughly speaking, this is just roughly speaking, your Citi options are going to be 150% the price of your MS options, just because the stock is higher priced. And the higher priced the stock, typically in the same sector with the comparable implied volatility, you're going to have a higher priced option if the stock price is higher. And so as a new student to options, I always say, well, reduce your risk. So take the Morgan Stanley instead. So whoever suggested I look at Morgan Stanley, thank you so much. That wasn't part of initially what I was thinking of presenting, but this is great. You are going to get some IV fluctuations within the day, and typically you get higher implied volatility spikes when the market is going down, but if there is a huge change in price, a lot of options being bought and sold, you're also going to get an IV increase as a stock and the option are rapidly going up as well. So keep that in mind. Paper trade these, set them up, and depending on the price of the option as well as your stop loss, identify in advance if this is if my upside of my bracket trade is taken out, then I want to buy, and then go ahead and already have figured out what strike price, what expiration, and what and how many contracts you're going to buy, and you could do that by figuring out what risk you want to put into a trade. Okay. So that's what I wanted to just cover regarding tomorrow's FOMC. Let's look at some trades that you guys might be in right now. VIPs. Was there a print? I wasn't paying attention, so no, VIPs. Wow, is that 2 million? 2 million at, okay, VIPs to me is a no trade because the average daily volume is, I believe, or wait a minute, no. Never mind. You have 8 million. Okay, that's all right. I misspoke or spoke too soon. Okay, so VIPs. Yep. Anything is bullish above, bearish below. So VIPs is one that partially because it's an $8 stock, I would trade as a stock. But partially, I would also trade it as a stock because the options have what I call our nickel options. And what nickel options are is if you look at all the bid and ask across all expirations, all strike prices, you see that they either end either in a 0 or a 5. So you have 5 cents, 10, 15, 45, 85, 30, 80, 90, 85, 90. And what that means is that you can only put in an order at the 5 cent increments. You can get filled. For example, this last order here was filled for 74 cents. So you can get filled in between. But in order for you to even put in an order, this person probably put in an order for 75 cents. which means that if the bid and the ask, and it was marking, and you're already at a profit, and the last one came at 72 cents or something, you can't just say, and even if it's going up, you can't put in an order for 72, 73 cents thinking, okay, I'm going to get filled for 1 cent better than Mark. You have to actually put in that order for the 75 cents. And sometimes you'll get a better fill, sometimes you'll get filled at that, but it can't be any lower. So I typically will stay away from what I call these nickel options. And typically when you have nickel options, you have less liquidity. Otherwise, they'd have penny options. Okay. So what are you guys saying about, Facebook print. Okay. Let's look at Facebook. Okay, print was at 171.41. And we're right there. So Facebook is a $170 stock, and so you can't just give it 4 cents a room on a stop loss. However, that doesn't mean that you need to give her $4 on a stop loss either. Oh, let me look at a weekly. Weekly, she's pretty flat. Your ideal trades on a directional options trade are always going to be when you have a cross. Two things that are ideal is when my pink line here is the 8, my purple line is the 4. So whenever you have a cross or a touch, and then you start seeing two moving averages get wider, that means you have more momentum. And then the other thing, if you can't at least have that, as in it's gaining momentum, is at least have something like this here where you have two parallel instead of one that's starting to, to converge here. That just makes for a much easier trade. But, the market doesn't always give us that. So right now, that print doesn't tell us anything, and we might have to give it some time and some wiggle room. 30. So if you go back to the 30-minute chart, kind of see this whole area where Facebook really hasn't done anything. And we had a momentary dip here, a dip here. And so we're kind of in this chop area, which makes for a really difficult trading, or it's much more difficult. Facebook easily gives you 50 cents typically on a day trade, but it's so much nicer when we actually get a break above or break out, something like that. But let's look at this 171.41. So let's dial in a little bit more. This is not it's kind of a real sloppy. She breaks down. She's got a good move. So So from 170, let's map out some trades. So the trade is bullish above 171.50, which is right here, right? I'm sorry, 172. Okay, so why did Stephanie, even though it's 171, the print is at 171.50 is the next major level up above 171.41. Why didn't she pick that? Well, she didn't pick it because there's just too much noise. So 172 gets you above all this noise here. Okay, so 172, you've got to trade from 172 to 172.50. And then you might want to hold, get out 50% or 75%, maybe. And then hold for 173. From 171, you've got to trade in 50-cent increments. So you have a 171 to 170, 50, and then to 170. So we set up our bracket trade. We draw this. We draw this box here, and I'm going to set. I like to set audio alerts so that my computer will ding me when we get close. And close doesn't mean that I'm necessarily going to enter, but it brings my attention back to the stock. So I want to set some alerts at the chains. My personal preference is to always trade front week, meaning the options that are expiring the soonest, because those give me the best bang for my buck. However, if the stock doesn't move, I have a greater chance of losing more, so I have a greater potential loss on investment than I do going out further in time. And only you can assess, well, I may have a greater LOI in terms of percentage, but it may not be a greater loss in terms of actual dollar amount. So you need to do the assessment individually and with each stock, each time of the day, whatever the IV is set by the market makers at that time, it's going to make a difference. So you can't come out and say at any given time with any stock, that, especially one that you're not familiar with, that one is going to be better than the other. You're going to have to take just a little time to assess. But let's look at, boy, there's really not a bias that I can tell right now. Okay, so let's say that I'm triggered into, we'll look at both the bearish and the bullish trade. Let's look at first the bearish trade. So I get triggered into my trade. Say that I get triggered into my trade. Yeah. $170.97, my entry. I may look at, I personally don't like at the money, and your 170 and your 172 puts are going to be near the money. But that doesn't mean that you should avoid them. So let's look at some potential prices of what this might be like. You have the 165, 167.50, 170, 172.50, and 175. Okay, that would be, we're at, so 50 cents from now will roughly give you, so your 167, 165, or your 165, it may cost you 15 or 16 cents. Let's say it costs you 16 cents to get in. This is probably going to cost you, let's see, let me do something here. Okay. The 165s, the delta is 6 cents, 7 cents. So this is, yeah, probably going to be about 16, maybe 17 cents. The 162.50, your delta, I'm sorry, I got the wrong thing. The delta is only 3 cents. So this will also be only maybe 36 cents. Your 170, or am I off? Let's see, 165. 165, the delta is 6 cents. 167.50, the delta is 15 cents. So 7, let's say that this is probably going to be more like 40 cents at your entry. The 170 has a 34-cent delta, so this is going to be about $1. The 172 or 167.50, 172.50 has a delta of 61, so that's probably going to be like 220. And your 175 is going to cost you $4.20-ish. So if I get in at 170, on the break of this 170, I have a print at 171.41. Okay, I'm not sure I want to give it, or let's see, yeah, so basically this becomes my stop loss because we're bullish above and bearish below. So basically I'm giving it a 50-cent stop loss, plus or minus, right? And so I'm giving it basically a half a delta of a stop loss. And so then I have to figure out, well, how much is that going to translate to dollar-wise? And do I buy, maybe, I don't know, do I buy 2 of these versus 8 of these, or, whatever the math works out. And my favorite trade on these is to buy out of the money. And ideally, I like to go to where my price is at, my exit is at the strike price. But in this particular case, I would probably go down lower to this 167.50. So I may decide, and this is just me, there's nothing wrong with going out to any of these other expirations, go out to November. We've got one trader in here that always goes out to January in a case like this. There is absolutely nothing wrong with that. In fact, when you're first learning how to do this, paper trade different expirations, and you'll find that they have a rhythm that will be more or less comfortable for you. And that's the one that you want. You don't ever want to get into a trade where you are breathing so hard, or your blood pressure, your pulse is, your heart is racing so bad that it is a real stress to be in the trade. I didn't have my chat up, so whatever you guys have been saying, I apologize for not keeping up. So let's look at it from a bullish trade. If say that Facebook breaks above 120, or I'm sorry, 172. Basically, we're looking at some call options now. And again, I could go, I could run the whole gamut from 165 strike to 180 for a dollar move. It's not going to give me enough. It's like, oh, it's only a 3-cent option. But with a dollar move, that 3 cents is going to become 4 cents. And I don't know about you, but that's not going to pay my commissions. And when we had that, what was this announcements? Okay, so this print on Facebook was 200,000. So if I do a $200 times 171.41, that's $34,282,000, which is 282,000. This times 100,000. So is that right? $271. I think it is. Yeah. So 34,282,000. So that's a little bit more than I trade. But we had, some time ago, we had a 3 million print. So if I were to compare that, roughly 3 million times 170, we were looking at $500 million on that trade. So that more, and the larger the print, the further I'm willing to go out of the money, because there is the potential for the stock to move more. And so this being a $200,000 or 200,000 share trade is big, but it's not this extraordinarily huge trade that we've seen in the past. And so I don't want to go too far out of the money, but I also still like to go out of the money because she's got a potential to move. If I didn't think she was going to move very much, or that this was a $17 stock that I'm looking for a 40-cent move instead of a $170 move, or a $170 stock that I'm looking for a $4 move, for example, I would definitely look in the money also. And there again, it all still comes back to, is there liquidity on all the options? And in Facebook is one that is traded heavily. There's a lot of day traders as well as swing traders in Facebook. If I expand this out, you could see that you've got really good volume. And remember, volume is what today's activity is. Open interest is what was there as of the close, or you could interpret it also as before the open. So this open interest does not change during the day, whereas the volume does change. But you could see that there is plenty of open interest all across, as well as there's plenty of volume. So you could go out to almost any expiration and any strike price without having to think. Okay, some stocks that we get where SCHW, Let's look at that. CHW. Our dear old Chuck Schwab. Okay, look at a stock like this, and first of all, you'll see that Chuck only has 5-cent options. And then you look at the open interest and the volume. So when I see something like this and I see this huge print, yeah, the stock may go really well, but I'm not sure I want to get into an options trade. Okay, at least you have some 1,000 open interests, so it's better than just having, 2 or 3. But it's not great. I'm trying to find something that's intermediate. What would be intermediate? What other things do we have? Prints in today. Let's look at float. Oops, not that one. OOT. Oh, it's a bond ETF. Did you guys know that? Right here. It's 2 million at 50.87. And it has no options, as is very typical. Let's look at CPN. It's another one with nickel option, but here you could see that here's the print on CPN, 1.75, 1.76 million. If I were to trade options on this, first of all, look at these spreads. That's 90 cents. This is $1.05 wide. This is $1.05 wide. Okay, I wouldn't want to do that, but for some reason, if I had a moment of madness and I wanted to do it, it's a no-brainer for me to only look at possibly this 15 strike call or this 14 put. Or going out to November, I would look at this 15 call or 14 put. Only because that's my only choices in terms of having any kind of open interest in volume. So when you have something like this, I was looking for something in between where it has enough that it's liquid, it's not nickel option, but that one will jump out better than anything else. And if that's the case, you want to take that. Okay, so general chat. Hey, Smitty, how are you? Hey, better late than never. So I've got 18 minutes. What do you guys want to talk about? So does that make sense on this Facebook, or how you would trade, any of these big prints? And what you want to do is, if a stock starts moving right away, you might want to just jump in with something that's really liquid. But if not, typically these guys will give you enough time to do a little research as to, well, what makes sense for my type of style of trading. What would make sense? Do I look at this week's options? Do I look at next week's? Do I go out 2 months out? And if it's something really expensive, and that really rarely happens, but say that we get a print on Priceline. which I've never seen a print on Priceline, but let's say that we do, okay? If you come into the chains and let's look at all. Okay, so Priceline is at 1920 right now. So here are the 1920 at the money, okay? It's $12 for the put and $13 for the call, roughly, plus or minus. I can go $20 OTM. And my put still costs me $4.50. My call costs me $5.50. That's going $20 out of the money with 3 days to expiration. And I'm thinking, geez, I'm not sure I want to pay that much. This is where you get into spread trades. You want to look at some vertical spread so that you're not risking or your entry isn't that high. Okay, you're going to be capping your losses, but you know, what if you can get into this trade where you're going to risk $1 to make $4? Okay, so, well, you didn't risk $5 to make $50, but you know, $4 on $1 investment, that's not too bad. So those are the type of trades that when you start getting into options prices like this, and then especially if you're not sure and you're thinking it's going to take longer, you go out 1 week further. So here again, 1920 is my at the money. I'm basically paying $20. Let me show you. I go $50 out of the money. I go $50 out of the money, and I'm still paying $4 or $5 for these options. So that's when I want to just do vertical spreads. Okay. All right. So that's looking at how we might trade any of these prints, as well as just assessing, well, is this one that I would want to? So the question a lot of times is, well, one, just because we see prints, you don't want to be taking every single one. So is the print significant? And what I mean by that is the other morning, after Friday, Broadcom had one print in the morning. It's 500,000 or something. It was big, and I got really excited thinking, oh, this is going to be my whisper that morning because it was huge. And then it turned out, well, there was another 250,000 print. There was another, and there were too many of them. And it was like, this is really suspect. And then I looked, and there was news on it saying, well, it's a merger at this price. And it's like, well, that's not quite a takeover scenario, but those prints were not significant. So that's the first thing you have to assess. Then two, is it tradable? And by that, I mean that, we saw some of these, we sometimes see these really unusual prints on ETFs that are rarely traded, and they're typically some fund, typically a pension fund or something that, has these large holdings. And they're not really typically tradable. So then the next thing is, well, do I want to trade the stock or the option on it? And then the fourth step then starts coming into if options. And then this is where I come in, is then I want to look for what option I want to get into. Or first, if it's optionable. And I love that word optionable. To me, optionable doesn't mean that a stock has options. It means that it has tradable options. There's a huge difference in that. And you got a little bit of a glimpse into how I assess that. So, looking at whether it's penny, whether it has weekly options or just monthlies, what the open interest is, what the volume is, various things like that. So, I don't know if you guys... Hey, Bob. How's the concrete pouring going? Okay. So we talked about Facebook, oil, Apple. Okay, I've got 10 minutes before I go to boot camp. Yeah, BA finally broke and is heading up. I saw that, Valerie or Lorraine. Okay, this might be the third test of that 260. She may fly from here. For those who weren't here before, I had called out a weekly. I was looking at this doesn't show it as well, but I had drawn in, this is what it looked like at the time, and she's breaking above. And when you have a pattern setting up on a weekly, it makes for that much more movement on a daily. Oh, I want to see what Starbucks is doing before I leave too. Oh, she fell down. She's falling down on the job. Oh, looks pretty spiky. As a day trader, you should have already gotten out. But as a swing trader, you might have scaled out some, but you could still be in this position. Okay, let's see. I am full of questions. Afternoon naps are good, Valerie. As Garfield says, when you take your afternoon nap, that gives you one thing to cross off of your to-do list, and it's a good thing. Okay. Well, this is an interesting looking chart. I haven't looked at Mo in forever. There was a period where Stephanie and I traded. We didn't trade Mo as much as we traded Lorillard, LO, and they both had really similar looking. So are you looking more, not so much, and maybe it's a gap. Let's see, is it a gap on a daily? Yeah. So, well, actually the gap, is there even a gap? There's not even a gap. Or there's well, I guess, I don't know if you could technically consider that a gap. Yeah, this looks really interesting. You've got, I actually like this chart. You've got resistance here. You've got resistance here, but you made it over the 50. This is typically really strong where you've got, you're trading under the 50, you're trading, and then you get this overnight gap over a major moving average. I like a trade to about the 67. Beyond that, I don't want to shoot for 71 or anything, but this has a real nice look to it. I actually like that chart. Well, typically on something like this, I want to take it a step at a time. So I want to put in one target, say at 66.50-ish, 67, and then by the time, we come up, maybe this 100, this green line is my 100. My 100 might be coming down to about 68. That's probably another good target. Because each time, whether I scale out or completely get out and then get back in, each time it hits, a lot of times we'll get, a pullback. And sometimes the pullback lasts 15 minutes and sometimes it lasts 2 weeks. You never know. Or at least I never know. And if you guys have a better crystal ball, please feel free to share it in the room. No trading advice or recommendations, Smitty. Just my personal opinion. Just how my personal perspective at looking at a chart. So what is this company? Oh, I didn't know Philip Morris still traded under that symbol. Yep. Okay. Thanks. That makes sense. So this brings us back to one of Stephanie's rules too, of look at the cousins of your different stocks. Sisters, brothers, cousins, the relatives in the same sector, look at the ETF. And so remember how I don't expect you to remember, but roughly I kind of touched upon, when I like to trade GS, on FOMC. This is my favorite stock to trade on FOMC. And at various times you get where the financials will move more than gold. And lately gold has been the most difficult, so I just haven't been trading gold, but the financials have been moving really nice. But what I want to always be doing is I want to always have XLF, an XLF chart next to my GS chart at all times when I'm trading as a minimum. And sometimes I'll put FAS or FAZ. Some of the other ones that I might look at are FAS, FAZ, BAC, and some of the other ones that we talked about, JPM, Citigroup, Morgan Stanley, Wells Fargo. I may be looking at those. And then I own some FitB long-term stock in one of my accounts. So sometimes I'll have that, just as a tiny chart over at the corner somewhere, just so that if it's completely tanking, I know either to be buying puts on it or I'm not really interested in selling it, but I'll buy some puts or do something to protect that position. So it's 2:00. I'm going to get back to boot camp because I promised them a presentation there. And so that's it for today's